Well, hello, everyone. Thank you for joining us. You might be listening on the radio, you might be listening to our podcast, and you might be watching this one online. So, today we have a very special guest who's back with us again today. He's already been on the show with us before, and that's Dr. Wade Pfau. And, there's so many things that I can say about him. But we're grateful to have him back on, and we're going to be talking about the second edition of one of his books today. But let me tell you a little bit about this guy. So, he is he's a best-selling author. He's the professor of practice at the American College, founder of Retirement Researcher, co-founder of the RISA with, I've got to say it, Alex Margia, because if I don't, he'll get mad at me. So got to throw that in there because we know he's going to listen. And he's author of the book, The Retirement Planning Guidebook, Navigating the Important Decisions for Retirement Success. And I can't say enough about this book. That's why I wanted to do an entire show on it today. So, Wade, thank you so much for joining us again today.
Thank you, Brad. It's great to be back on the show. And now you've been on our podcast. Alex and I have the Retire with Style. So we've got a lot of back and forth here. Great
Hunter
to be back.
and I were on episode 71 that just aired, about a week ago. And then I noticed, ironically, we didn't know all this timing was going to work out, but the episodes that followed ours went into annuities. And as a matter of fact, I think it was Wednesday morning, the fixed indexed annuity Retire with Style episode came out, and I listened to all that when I was walking before daylight. And knowing that we're going to be talking about that a little bit on today's show, at least one little part of it. So it's kind of neat how everything all comes together. We didn't even know it was going to happen. So that's great. So
Good synergies.
Let me ask you this. I know you've written Safety First Retirement Planning, excellent book. You've written a book that now has a second edition about reverse mortgages. And you've now written a second edition to the Retirement Planning Guidebook, and I'm so glad you did. I've got your old book up here because I'm going to be using the new one, and I've got notes all through it, posted notes everywhere. But let me ask you this: having written two books, and I know I'm working on a second edition to one right now, why did you decide to go back in and do a second edition to Retirement Planning Guidebook?
Well, a couple of issues. And one, I really want it to be a comprehensive book that is the go-to resource for both individuals and financial advisors. So I need it to be up to date. And in that regard, I really probably should be doing annual updates to just get all the new numbers aligned. So that's part of it. But then a lot's happened. It was first published in September 2021. The new edition came out in March 2023. So it's fully updated. I've been doing more research since then, so there's a lot more content on the tax planning and on the Affordable Care Act, subsidies, and so forth. And then also Secure Act 2.0 was enacted late last year, which nothing super major in there, but so many small, minor changes. It was troublesome going through very carefully, and I've got to make a little adjustment to this sentence based on the new rules and so forth.
Yeah.
But I wanted to make sure it was fully up to date with the new legislation as well.
Very good. And just to take a second to deal with that, if you're a consumer that's listening, someone that's about to retire, we realize how difficult it is for you to keep up with all these changes because it's difficult for us. Just take one thing, the Secure Act and then Secure Act 2.0. You have required minimum distributions known as RMDs. And everyone knows they're at 70 and a half, right? So we've written all of our books and have our material and articles all over the place. And then, that changed. 70 and a half becomes age 72. But some people fall under the 70 and a half and some people fall under the 72. And then Secure Act 2.0 comes out and goes, oh, well, no, wait a second. Now it's 73. And so you have people that fall under 70 and a half and 72 and 73. And then they've already announced an age 75, 10 years from now. So it can be so confusing. And that's why I'm thankful for people like Wade. And I know Ed Slott just updated one of his best-selling books. And you kind of have to do it about every year because of all the changes that are always taking place, right?
That's right. Yeah. And that required minimum distribution change this year, that was when you're trying to make it as efficient as possible to update things. We always just had the one RMD age, and It was either, as you said, 70 and a half or 72. But now you have to, every sentence is, depending on when you were born, it's now either 73 or 75.
That's right.
So that's a fun change to make as well.
Well, for those of you listening, I'll tell you what I want to do today. So let me put my readers on. I know if you're listening on the radio, you can't see me doing this, but I have reached the age where the glasses have to come on now. So I want to read to you from the back of Wade's book because my good friend Ed Slott has given him an endorsement on the back of this book, and I want you to hear what America's IRA expert says about Wade's book. Dr. Wade Pfau shows us why the concept of retirement is different for everyone. This definitive guidebook shows you how to recognize the strategies that will work best for you and your family. The anxiety that typically comes with making difficult long-term financial choices will be replaced with confidence because virtually every possible retirement planning option is explored without bias. To me, that is critical. You will finally be able to take what you learn here and apply it to your personal comfort level, whether that involves taking more risk, looking for more safety, or somewhere in between. This retirement planning masterpiece is the first step towards a successful retirement plan. Now, Wade, I know you know Ed well, and to have his endorsement and have him say things like that, what a blessing. I mean, he wrote the foreword for my book, Bulletproof, and there is arguably no one on the planet that knows more about taxes and retirement research and planning than him. He's in a group with you and Tom Hegna and several other people, Michael Finca, David Blanchett. Don't want to make anyone mad, but there's some key people there, and so I love what Ed Slott said about Wade's book. I want you to stay with us today. Today, we're not going to take a lot of breaks on the show. We're not going to go to commercial very often. I just want to give you a key phone number, 866-780-SAFE. That's 866-780-7233. You can call us anytime, request a free copy of my book, Bulletproof, the Safe and Secure Retirement Income Plan. We encourage you to order Wade's book. I'm telling you, it's a Bible for retirement planning. So call in anytime, 866-780-7233. We'll be happy to help you any way that we can. So Wade, when you started this book, you wrote something at the beginning that I absolutely love. It says, to those seeking to do something great with their retirement. And I love that. So I want to share with our listeners some things just so that they realize how much stuff is in the book. This isn't about any one topic, so just listen. Retirement income styles and decisions, retirement risks, quantifying goals and assessing preparedness, sustainable spending from investments, annuities and risk pooling, Social Security, that chapter is fantastic, Medicare and health insurance, long-term care planning, housing decisions, tax planning. It just goes on and on and on. So that's why I call this a Bible. It's got it from cover to cover. It's got everything about retirement planning covered. So we're going to focus kind of on a couple of different things today, but we want to talk about some, because of the show, Safe Money Radio, how you might fit annuities into a retirement plan. And I know that you say in there at one point, Wade, that you talk about stocks and annuities to fill in the gap. And it's kind of always been stocks and bonds. So tell us a little bit about that. Where's the stocks and annuities versus stocks and bonds? Where's that come from?
Yeah, so my background, I'm more from the investments world and got involved with looking at how the investment world approached retirement income, which is really not much different from pre-retirement. You just flip a switch and you start spending from your investment portfolio. And I became concerned about some of the rules or guidelines from that world, and then started learning about insurance and annuities as maybe a way to help with that. And so going back now 10 years, I wrote an article on the efficient frontier for retirement income, which takes investment principles but applies them to, no, you're trying to fund spending over your lifetime now. And found that efficient frontier was, rather than using a stock bond portfolio, it's more about stocks and lifetime income protections, or stocks and annuities, where annuities replace the role of bonds as a better, more efficient way to meet a lifetime spending goal. It's just bonds, you can't spend more than the interest rates will allow for.
Right.
And you have other ways to potentially spend more than bonds. With stocks, you're hoping stocks will outperform and provide you higher returns. Now, there's no guarantee behind that, but it's more historically, it seems to work. So if you're comfortable with that, great. And then annuities provide this idea of risk pooling, where the insurance company, they're effectively investing in bonds, but they allow for this idea that there's some people who may live a very long time. There's some people who may not live as long. But if I join into this risk pool, I can spend at a higher level because I don't have to be as worried about, well, what happens if I live to 90? I don't want to run out of money. That's where the insurance or the annuity, the risk pooling, is going to continue to support those payments no matter how long I live, and allow for a higher standard of living for everyone in that risk pool compared to what you could get with the bonds alone. So risk pooling through insurance is really a lot more powerful than bonds. Stocks
Yeah,
still provide the growth potential, but put those
right.
together and you've got yourself a retirement plan.
And I guess for those who, a lot of times in life, I guess something doesn't become important to you until you deal with the issue that makes that rise to the surface. So for people who were retiring last year, maybe the beginning of 2022, they obviously retired maybe with the investments and bonds concept, and then boom, what happened? The market goes down, and there was no inverse relationship. Stocks went down, and so did bonds. So where does an annuity come in and change the sequence of returns risk, I guess, and the safety portion that can happen when we go through a year like last year?
Yeah, yeah, and people don't always realize that bonds can lose money, especially if I have like a bond fund. So I'm not holding individual bonds. When interest rates go up, it pushes down the price of bonds because nobody wants those old bonds with lower interest rates anymore. If they're going to buy bonds, they just want to buy a new bond with offering a higher interest rate. And so you saw double-digit losses in both the stock and bond markets last year. And that can really disrupt a retirement because if somebody retires at a time where markets start going down, to meet my spending, I have to take distributions from my portfolio and I may have to sell from the portfolio at a loss. And then even if the overall market recovers, the individual's investment portfolio doesn't enjoy that recovery fully because there's now missing parts of that. You had to spend that money. So it's gone. It was sold at a loss because you needed to spend it and you don't get the full recovery of the market. And that's where having other types of protections that don't have that potential for loss can help retirees, especially help manage that risk of market losses early in their retirements.
Very good. If you're listening right now and this is something you've never heard of before, that's okay. Because literally every day of my life, someone that's heard me on the radio or listened to a podcast calls in and they may be in their 70s and say, I've never heard of anything like this. I didn't even know there was something safe that you can do. And even though the safety side of things is a $350 billion a year industry, there's still, you don't know what you don't know. And so until you hear something, you can't possibly know about it. So we're going to be talking about it more on today's show. If you want more information, just call us anytime at 866-780-SAFE. That's 866-780-7233. We'll give you our information free. I'll mail you a copy of my book, and you can learn more about this at your own pace. So Wade, I know in Chapter 5, you actually talk about annuities and risk pooling. So tell me this. The concept of guaranteed lifetime income, how can you even use the word guarantee? Explain that. How can an annuity come into play in a retirement plan? And what is it about this guaranteed lifetime income stuff? How's that even possible? How can they do that?
Right. So an insurance company can write contracts that provide contractual guarantees. And when you're looking at annuities for lifetime income, it's a guaranteed contract. And I started to mention the idea we don't know how long we're going to live in retirement. It's called longevity risk. It's really the biggest risk in retirement. If you're retiring at 65, you don't know if you're going to live to be 66 or if you're going to live to be 96 or 100 or beyond. And so you don't really know what's a sustainable spending level. How much can I spend so that I can fully enjoy my retirement, but in a manner that doesn't cause me to run out of money? And if I'm trying to self-manage that longevity risk, I may be worried, well, what if I'm 100? I don't want to run out of money at 100. I have to spend a lot less to make sure I don't run out of money. What the insurance company can do with the contract is pool risk. Any one individual doesn't know how long they're going to live, but if the insurance company has tens of thousands or hundreds of thousands of customers, they know what the whole curve of longevity looks like. They know that a
Right.
certain percentage of people will live to be 66 or 70 or 80 or 90. And so they have the ability to pay everyone at a level like they'll live to their life expectancies, which are generally in the mid 80s. And if I can spend like I know I'm going to live to my mid 80s versus being worried I might live to 100, I can spend at a much higher level. And that's what the insurance company is able to do, because those who then don't end up living as long, well, they don't need as much money for their retirement. I mean, unfortunately, they don't live as long, but while they were alive, they could enjoy a higher standard of living because everyone is part of that risk pool knows that if they live a lot longer than average, they'll receive these subsidies from those who didn't live as long. And it raises the standard of living. Everyone in that risk pool can enjoy a higher standard of living, and it can be contractually protected because we know what the longevity curve looks like. We know with a large number of people that maybe 10% will live to be into their late 90s, but the insurance company can manage that and ensure they have the sufficient assets to provide that because it's coming from people who didn't live as long. It's helping everyone enjoy a higher standard of living.
That's such good information. I know that's what confuses a lot of people. They're like, how can they do that? And I always jokingly say that the highest paid or the most important people at the insurance company are the math nerds, the actuaries. They can tell you the day you're going to die because of how many people they have as clients. So that's great information. And we're going to be talking about all these different types of guaranteed accounts that are out there, different types of annuities. And that part can get really confusing because there are a lot of them. It's not a one-size-fits-all. So stay with us. And if you want more information, a couple of things you need to do. You need to order Wade's book and just call in anytime at 866-780-SAFE. That's 866-780-7233. I'll give you a copy of my best-selling book, Bulletproof, The Safe and Secure Retirement Income Plan. We talk about annuities in part of that book, and it'll have some great information for you. So call in anytime. Now, Wade, I want to shift gears here and go into something, and I'll try to make myself slow down, but this is something I'm very passionate about. So as a certified annuity specialist, I had to go in and study many of the things that you've obviously studied, all these different types of annuities. There's SPIAs, DIAs, MIGAs, variables, fixed indexed, fixed. And so what does any of that even mean? Well, a SPIA, a single premium immediate annuity, that can be a great part of a portfolio and fit. A deferred income annuity can be a great fit. A MIGA, a multi-year guaranteed annuity, which is in essence an insurance company's CD, just a short-term guaranteed fixed rate. There are variable annuities that give you the upside with guaranteed lifetime income. It can also participate in the downside, but has higher return potential. And then there are fixed and fixed indexed annuities. So I understand the consumer, especially those that are listening, are like, someone told me I need to buy an annuity, and so here I am to buy an annuity. Well, that's the first of many, 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 many steps. And I may even talk about that in a little bit more detail about what it's like when someone calls in and says, okay, I want one of these annuities. But I know in your book, because of time, we can't go into every one of those, but we're going to talk about one specifically, Safe Money Radio. A lot of people are looking for kind of the middle ground. They want the safety of their principal. They want to know they're not going to lose it. They also want to know they've got this guaranteed contractual lifetime income. And a lot of times that's a perfect fit for a fixed indexed annuity. And I know in your book you call that the middle ground between an income annuity and a variable annuity. So talk to us a little bit about the fixed indexed annuity, what it is, kind of how it works, kind of maybe on a high level scale.
Mm-hmm. Right. So fixed index annuities, they are that middle ground. And I usually, because of focus on retirement income, think about annuities for lifetime income. And you get that generally with a fixed index annuity by having a living benefit attached to it. But also just with the tax code in the U.S., annuities do get tax advantages. And so sometimes people also talk about fixed index annuities, not necessarily for lifetime income, but because they provide an attractive after-tax return compared to other potential bond investments that they may be looking at. But the fixed index annuity, the way it's structured, it provides principal protection. People can't experience losses on them, and it's because the insurance companies just buying enough bonds to make sure that when those bonds provide their interest at the end of the term, you've got the principal fully protected. Because interest rates are greater than zero, it doesn't take all the money to provide that principal protection.
Right.
So then with a portion of that leftover, they're going to buy exposure to a market index such as the S&P 500, which then gives you can't experience a loss. Even if it's linked to the S&P 500, even if the market's down 40%, the bonds protected your principal, and then you wouldn't get any upside from that. But if the market's up, you are going to share in a portion of that upside through the financial derivatives that the insurance company is purchasing with some of those leftover funds. And so therefore you get principal protection. You can't experience a loss. You're not going to get the full gain of the market. You shouldn't expect that, but you will get a portion of any market gains as well. And then when you consider the tax advantages, that can be an attractive alternative to other, not, it's not a replacement for stocks, even if it's linked to a stock index, but it can be a nice replacement for some of the bonds. It can outperform other bond options. And that's where a lot of the interest lies. And then if you overlay a lifetime income benefit on top of that, then we're entering that world of having that risk pooling insurance, lifetime income protection as well.
Very good. I say a lot on my show, I own 6 annuities, and they are all fixed indexed annuities. It's not because they're not other kinds that would work great. I almost purchased a MIGA this year, and I'm going to end up owning several more. I'm 52. By the time that I'm looking at retirement squarely in the face, I'm going to own several, and there's a reason why. Laddering, turning on income riders at different times. But right now, of my 6, I only have lifetime income benefit riders on 4 of them. 2 of them are just to protect my principal and have maximum growth inside it with no market exposure, because I've already got the market exposure side covered. I've got a 401k and all other things that fluctuate up and down with the market. But yesterday's a good example. I had someone come in, first time. They've been a brokerage clients living off investments their entire life, in their late 60s. And as we started talking, they said, we didn't even know there was anything like this. And of course, I think the question that comes up all the time is, how can they do that? And we've talked about that some today. How can an insurance company protect my principal and allow me to participate in something that's it's not a stock replacement, like you said. It has index potential that can be tied to the S&P, but if it goes down, I don't lose my money. And then the key part for a lot of people is they either need income right then or they're going to need it in the future. So in our next segment, I want to talk about what you mentioned. I think in your book you said, when you couple it with a living benefit, then a fixed index annuity side provides a source of protected lifetime income. And I want to talk a little bit about how that works on a guaranteed basis. So if you're listening right now, you want to know more about this, you need the Bible regarding retirement planning. You need to get a copy of Retirement Planning Guidebook and how to navigate all these different decisions about Social Security, taxes, housing, whether or not you might need a reverse mortgage, how much should you have it with market exposure versus the guaranteed side with maybe an annuity. So that's what you need to do. Call us anytime at 866-780-7233. We'll be happy to talk to you about your specific situation and help any way that we can. So, Wade, here's what I want to do. I want to talk about this for just a minute. I'm from Arkansas originally. It took me about 10 years to get the slang out of my voice. Some people listening now say, oh, you've still got it. But I grew up in Arkansas, and I played college golf. And at the time, professional golfer John Daly played for the University of Arkansas, went on to become a major champion. And his philosophy was grip it and rip it. He had this big, huge swing. Everyone knows it's seen John play. It was all about hitting the ball as far as you can. And in your book, you actually talk about, I'm going to say this, grip it and rip it. You talk about grip. So what is grip when it comes to retirement planning? Explain this to us.
Well, I had spent 10 years working in Japan at a university named GRIPS, so I like that analogy, the grip. But GRIP just refers to the idea of guaranteed retirement income percentage. And other people talk about the same concept, like it's called many different names, like reliability of income and so forth. But it's when you look at your budget in retirement, what percentage of your budget is covered by guaranteed income sources? So that's Social Security, pensions, traditional company pensions. It could be some individual bonds, and then also the annuities with the lifetime income protections. And the higher your grip, the more of your income covered from guaranteed sources, the less you have to be worried about stock market performance, because the less of your spending doesn't have that grip. If markets do well, you get upside, but if markets do poorly, when you have a higher grip on your retirement, a higher percentage of your income coming from guaranteed sources, it's just you can sleep better, or you don't have to be as nervous about what the market is doing, because less of your overall spending is being sourced to that sort of volatile source outside of these guaranteed income sources. So that's what grip is. The higher the grip, the easier it is to sleep at night. It's the easiest way to think about it.
I love that. And so I know Tom Hagnell will say the 2 most important decisions you'll ever make: how much guaranteed lifetime income do you have, and have you taken the key retirement risks off the table, which you talk about all that in your book. It's, do you have the contractual guarantee on your income? that because, like you've said, in the stock market, which most all of us participate in, we don't really know how much we can take out of it each year from year to year. Depends on how the market's doing. One theory is you should never take income out of a market-driven account in a down year because of sequence returns risk, and that. So you need that part of your portfolio. You're okay with the risk, but you need to have something that's guaranteed. Make sure that you've got a grip on your retirement by having those things that are contractually guaranteed for the rest of your life. So I think in your book you even said income annuities provide a license to spend more from the start of the retirement due to the insurance company's ability to pool risk. And that's really what we've been talking about today. Explain that just a little bit. How is it that they have a license to spend more if they have something like this?
Mm-hmm. It gets back to this idea that if I don't know how long I'm going to live, I don't know how much I can spend if I'm trying to manage that risk on my own. And some people get more worried about that than others. If you're somebody who's really worried about what happens if I live to 100 and run out of money,
Yeah.
it really forces you to spend less because you're worried. You don't know what's going to happen. You don't feel like you can spend your money. You don't feel like you can fully enjoy your retirement. But the insurance company has a much more effective way to manage that risk. They don't just require you to spend less because you might live to 100. They can pool that risk with a large collection of their customers so that they know what the average person's life expectancy is. They can allow all their customers to spend like they're going to live to their average life expectancy because they know that no matter how long they live, they're going to continue to receive those checks. And it's just the idea, the way that works is some people don't live as long. They help to end up ultimately subsidizing the payments to those who live longer,
Right.
which may sound like not a good deal for those who don't live as long. But when you don't know in advance which side of that line you're going to fall on, you really, no matter how long you end up living, you enjoy a higher standard of living. You get to spend more comfortably because you're not so worried about this idea that what if I outlive my money? You have this contractual protection that even if you live to 100 or beyond, you'll continue to receive those monthly payments in the mail, and that will allow you to continue to spend and enjoy your retirement. And that's the whole idea behind risk pooling. That's why annuities offer a really attractive feature to somebody trying to spend over a lifetime when they don't know how long that lifetime is going to last.
Very good. I know my father was an advisor for 52 years, and his philosophy about income planning in life was, I want to die the day I spend my last penny, right? That's what everyone says. That was his plan. And I thought, I want my cake and I want to eat it too. I want it to be better than that. And I think it's Wall Street Journal, but there's an old article about people are happier when they own fixed indexed annuities, and the reason being they know they can live. It doesn't matter how long they live, the money's always going to be there. And so my philosophy is I want to live past my money. I want to live on the insurance company's dime, and I want them to have to keep paying me when I've gone to zero. So that's really the silver lining to that. But there's some neat concepts there, and I want to talk more about it. So stay with us. We've got one more segment. We're going to kind of try to put all this together. I wish I could talk to Wade for 3 hours on here, but we got to respect his time. So call us anytime at 866-780-SAFE. That's 866-780-7233. We'll be able to answer any questions you have about this, about retirement income planning, safety, risk, what your proportion should be. Just call us anytime. Ask for a free financial consultation. We'll be glad to help. So, Wade, today, as we kind of put all this together, I know we've been talking about retirement income planning and some of the different tools you can use, but I want to ask you a question because in your book, especially in the section about annuities and risk pooling, you talked about why it's important. Actually, I'll read it. Why it's important to work with someone who is familiar with the vast array of available annuities and who understands which work better for different purposes, ages, and deferral periods. Now, in today's world, the annuity used to be a bad word. Now it's not. Now everyone wants to sell you an annuity, and everyone wants to establish one because people realize their worth. There's been a lot of recent studies and research about how powerful they are. But it's probably a good idea that you don't just go buy one from just anyone. Why is it important to find someone who is maybe has special qualifications when it comes to purchasing something like this in your retirement plan?
So, well, because there are a lot of different annuities, different insurance companies even offer many different annuities through the same company. And you start to hear these terms like, do you want income now, income soon, or income later? And also depending on what your current age is and whether you're looking for one individual or for two, the best annuity for different scenarios can vary quite a bit. And so even this is an area where if someone comes in and says, I'm 67 and I want income to start at 76, I wouldn't necessarily know where to start with the vast universe of annuities. So having somebody who does specialize in this area and is familiar and comfortable with all the different products out there and has a good sense of, okay, insurance company A has a pretty good option for that specific scenario. Whereas if I was 62 and starting income at 65, it may be a completely different annuity option that provides the best protections for that scenario. There's not just a one-size-fits-all answer to the question of which annuity should I pick. And so working with someone who does have comfort and knowledge about all the options out there and how they fit best in different scenarios is really important to make sure that you are finding the best available option in the universe of what all is out there.
Very good. I would say if someone tells you that you need to buy an annuity, if it's an advisor or a professional, and they're saying, hey, we think you need an annuity in your portfolio. First question is, do you own any? And if they don't, if they're telling you to do something they haven't done for themselves, should probably be a red flag. Ask to see it. I own 6 of them. But then also you might ask them, okay, what's your education background? You have any special designation regarding this? That's why I went through the Certified Annuity Specialist program through the Institute of Business and Finance to know all the things inside and out. And so I'll tell you where we start with a client. And for those of you listening right now, I really want you to pay attention to this part, because long before the annuity question comes up or any other part of their portfolio, when we meet with someone for the first time, we use something called the RISA, the Retirement Income Style Awareness Questionnaire. And actually our guest on the show today, he helped create that, the co-founder. So that's our very beginning step that we take with a client. And Wade, I want you to tell us a little bit about that so that we can explain why that's the first step we take with a client when they come in to talk about their financial planning. Tell us about the RISA.
Yeah, and thank you for being a leading advocate of the RISA, the Retirement Income Style Awareness. So ultimately, I'm agnostic about retirement income approaches, and there's a lot of different options out there. What we've really been talking about today mostly is the income protection style. And the research that I've done, I tend to look at things more from the mathematical, quantitative perspective. And you can really make a strong case that income protection mathematically is the best way to approach a retirement income plan. But I do come from the investments world, and I've seen so many expressions of the idea that I don't need an annuity. I just want to use an investment portfolio.
Sure.
And at the end of the day, I have to acknowledge that some people are just fundamentally more comfortable using only investments. That's we call it the total return style. They really believe that the stock market can be relied upon to fund their retirement, and they want the full optionality that an investment portfolio can provide them. So, okay, if that's your preferences, at the end of the day, I'm not going to argue against that. And I think it's important for people to really have a strategy that they're comfortable with. But what's been missing is there's no framework to really understand what strategy is someone most comfortable with. So the RISA was based on a research project that Alex McGee and I did, where we looked at what explains how people think about retirement. And we found these factors that help to describe the broad retirement strategy options that are out there: the investing approach, the bucketing approach, the lifetime income protection flooring style approaches. And we ultimately, if you start looking at the consumer media, usually the default is always something like the 4% rule or just spending from your investments. And we find that really only seems to resonate with about a third of the population. 2/3 of the population are looking for protections or a commitment to a strategy that an investment only type option doesn't provide. And by a small margin, but usually the most popular strategy we see is income protection. And that's where you do look at fixed annuities, fixed index annuities with lifetime income as providing strong guarantees against market risk, but also higher levels of lifetime income than sometimes some of the other types of variable annuity options can provide. And then if that's what makes you comfortable, if you really seek having protection for your basic retirement expenses and you're comfortable, you actually value committing to a strategy so you don't have to be as worried about this and making all these adjustments in the future, that's income protection. And you can, if your RISA style is income protection, you'll feel a lot more comfortable with what you're hearing in this episode in terms of this is the approach that's going to work best for your retirement. Plus, it is the mathematically best approach anyway. But again,
Right.
that's where I concede that not everyone's ultimately going to want to use what's mathematically best. But finding it also has to be behaviorally best, and allowing the RISA allows people to start with a strategy that behaviorally they're more comfortable with as well.
Very good. And this is why, Hunter and I, we use the RISA with all of our clients. Make sure when you go talk to anyone who's doing financial planning, make sure that they're well-rounded, that they can offer all sides of financial planning. I do represent the safety side with our clients. Hunter, my son, actually represents the investment side. We are both retirement income certified professionals. We took that program, that designation program, through the retirement or through the American College, and Wade was our professor for many of our courses with other people. So we're grateful for him and for all of his knowledge. And that's why we choose to use the RISA. When someone takes it, it will put them into one of four quadrants, and we'll know whether or not there's risk wrap or it's income protection or whether or not it's maybe an investment only side or they're more aggressive. And we help them figure out how to marry their different needs, because a lot of times, Wade, I know you know this, but we'll have a husband and wife in and we'll have them both take it. Mm-hmm. And he may be more aggressive and she may be, no, you need to protect my money. And we have to figure out how to fit that all together. And share just a quick story as we end today, because someone actually contacted me recently. They did through the website. When they found me, they heard me online. They ordered both of my books, and they read them, and then they contacted me and said, hey, I want to talk to you about my situation. And very, very unique situation. This person actually has 22 different financial designations. They're no dummy. Very, very, very smart person. And then in a small world, actually find out that they're a colleague of Wade's, and they're someone that has said, hey, I need your help. I've got all this financial information in my brain, and I teach students about it all the time, but I don't know how to put it all together. And so if you're listening right now, we want you to know you might have a very in-depth financial knowledge, and you may have very little. You may probably have spent the majority of your life working and taking care of a spouse and your children and all the things that are going on in your world, and you may not know the difference in a 403b and a 401k, and that's all right. You need someone to help guide you. But even with this person with 22 different financial designations, I said, I want you to take something called the RISA. And he said, oh, I've already taken it. He said, I've taken it 3 times. And so we start laughing. I said, really? Well, what quadrant did you fall into? He said, oh, I'm in the safety bucket. Protected income, no doubt. That's why I need your help. So it was good to know that he'd already done it. But with anyone else that calls in, we want you to take this retirement income style awareness to find out kind of where things are in your world and what your stomach for risk is versus safety versus guaranteed income, estate planning, that sort of thing. And that's where it all begins. So we're grateful for Wade and for Alex Margia for what they've created here, and that we can use this incredible tool with all of our clients. And if you're listening right now and you're working with someone and maybe something just doesn't feel right, or they've never even asked you any questions about why you're in what you're in, just give us a call. We'd be glad to help. Call us at 866-780-7233. We'll actually let you take the RISA free. We'll send you a link to take it, and then we'll get together and go over a customized report and talk about what the RISA has uncovered for you. So, Wade, thank you so much for being on the show today. Any parting information you want to share with our listeners as we close?
Well, if anyone is interested in reading the Retirement Planning Guidebook, the best outlet for that is Amazon. Most of the copies are sold through Amazon, and that's also the easiest way to just make sure you get the second edition, which does have the yellow second edition on the top.
That's
if you're
it.
looking at other
Right
booksellers. Yeah. If you already own the first edition, it's not necessary to get the second edition, but I wouldn't want anyone to mistakenly get the first edition when they meant to get the second edition. And so Amazon's the best way to make sure you're getting a copy of the second edition in the most straightforward manner. And it's called Retirement Planning Guidebook by Wade Pfau. Since I published, there's a few other people that use the same title, but they're not going to show up in the search results. Although if they do, just make sure it is the black cover with Wade Pfau as the author.
And I know you've got one of these unique last names like I do. So that's F-A-U, Dr. Wade Pfau. So, and I got the hardcover edition. I love having the book in front of me. I'm one of the people I like the smell of the book. So, I've got all Wade's books. I highly recommend them. If you want to get a grip on your financial plan, you need to order all of his books. This book is fantastic, and get the second edition. So you can go on Amazon. Call us anytime. Those of you who are listening, you want more information, 866-780-7233. We'll be glad to help. Wade, thank you so much for being on the show today. We look forward to having you on again. And a happy 4th of July, everyone. We're right here on the eve of the 4th, and happy 4th of July. Thank God for this country. God bless America. You guys have a great and happy holiday.